Hi, I'm Keith McCullough. Welcome back to Real Conversations. I'm here with the founder and CEO of Ciovacco Capital, Chris Ciovacco from Atlanta, Georgia, to talk about his process, what he's thinking about the markets, specifically right here and now. So Chris, first, welcome, and I wanted to just get right into what it is that you do. What's your process?
First, I just want to say thank you for the invite to come up here and talk. I also wanted to say thank you to your staff. Everybody I've interacted with has been extremely friendly, knowledgeable, and what really has impressed me, enthusiastic about what you're doing here.
Thanks.
And where you're going, and that's a good reflection on what's going on here.
Well, thanks. They put up with me, which is kind of an interesting thing. Right? But I've been really impressed, following you on Twitter. Twitter's a very unique ecosystem. It's very new, as you and I both know. But I've always been curious and to kind of go a little deeper into what you do. So I wanted to kind of give that opportunity to you in terms of explaining what it is that you do.
We look at the markets if your objective is to try to improve your probability of success. A good place to start is, how do asset markets work? And it seems overly simplistic, but asset markets are a place where it doesn't really matter particularly what you think or I think. And when you hit that point, that's maybe a turning point.
Because the markets truly do not care what Chris or Keith think.
They don't.
Yeah.
And how many of your viewers out there would agree with how many people out there would have expected that the stock market would have done what it's done over the past 5 years?
Yeah, very few.
Very few. And it doesn't matter what we think. It's the aggregate opinion of millions of people, billions of people, impacting asset prices that ultimately determine the value of our portfolios. Therefore, if that's what determines the value of our assets, then if we can develop a way to monitor that aggregate opinion, which is when the net aggregate opinion is optimistic about the economy, Fed policy, earnings, we get trends that look like this. They trend upwards. And when we get indecisive markets where doubt starts to creep in, we get consolidation and indecisive looks. And when we flip over to a net bearish outlook for future economic outcomes, we get downtrends. And you can look at that on different time frames. That would apply to a full bull-bear market. It applies to corrections and subsequent rallies.
So you're basically trying to probability weight the slope of the line, either the continuation of a trend to the upside, a flattening of a trend that's changing, or a trend that's actually going from nothing to something that's breaking down. So you're really just trying to probability weight that constant move towards the next phase, if at all we're going to go into a new phase.
Absolutely. I'm not a big fan of forecasting, but everything we do in these markets is probabilistic.
Yeah, I mean, you've tweeted that, and we also talked about it. So, I mean, can you hit on that? I guess the feeling that people on Wall Street have to have a forecast, they have to be buckled into something, versus how you tend to talk about markets, which is being much more flexible.
Right. It really comes down to a marketing thing. The investing public demands forecasts.
Right, because they demand certainty.
They think that's what they need, right? And what they really need is a way to monitor the market's current risk-reward profile. So weather analogies do hold up well. How do you decide how to dress every day? You get up and you look out the window. So weather shifts over time. So if we look at the weather on July 4th, and let's say that's peak euphoria up here, July 4, and then around January 22nd here in Connecticut is March 9th of 2009, you wouldn't put on your trench coat on July 4th, and you wouldn't put on a bathing suit down here. So if we monitor the market's profile is radically different here than it is here. If we know that, then intuitively we know that incremental changes have to take place between October 2007 and March of 2009. It doesn't necessarily involve long-range forecasts. It's more important just to pay attention to the knowns that we have in front of us. So the knowns, I can go out and look at economic data, charts, risk-on, risk-off ratios, and know that with almost 100% degree of certainty, maybe with a little bit of 2% error in reporting. As soon as I start to move out, you ask a weather forecaster how far he's confident going out, after the 5th day, they basically say it's almost a coin toss.
Of course, yeah. What's fascinating is that it takes a lot of humility to say what you just said, and I appreciate that, because It takes somebody who's been in the trench, who's made mistakes. You know, this is the game. The game is not telling people that you're Nostradamus and predicting these long-range weather patterns. It's actually adapting and being flexible, and it seems that you know, really is fundamentally core to what you do.
It's an integrity issue.
Right.
I agree 100%. That's just because that's what people want. In fact, I remember in the auto industry once, I heard, don't give the people what they want, figure out what they need.
Exactly.
And that's what we need to do. We need to figure out what they need to be focusing on and what actually is important for them to manage risk, not necessarily what they want us to tell them.
Mm-hmm. Yeah, I mean, you get into these conversations all the time. I can't add up how many times on Twitter I get asked, what is your S&P 500 year-end forecast? What is your GDP forecast? You know what? My forecast is that I don't have a forecast. That's the point, because only an idiot would put a wire-to-wire forecast, January to December the 31st, as a target. Like, you're going to miss that target almost 100% of the time, but you might get paid for it on Old Wall Street. So that, I think, it makes we're just talking about new things. I think we're bringing to life how the buy side actually manages money, as opposed to the way that we want to tell people that they may think about managing money. So it's kind of an interesting time in that regard.
It's absolutely relevant. Forecasting brings bias too. We're all human, and if I come on here and I tell you that I think the stock market will go up 20% in the next 6 months, when I go back to Atlanta, everything I do, whether I know it or not, consciously or subconsciously, I will look at the market through a 20% upside bias lens.
Absolutely. I mean,
and that destroys your flexibility.
When in reality, at least this is what we do. I mean, I start with what the market's telling me to do, and then I go backwards and I storytell from there. I think people that forecast start with where they want the market to be and spend their whole day trying to explain why the market should be there.
Correct.
That is the upside. Maybe that's why I don't get along with a lot of people on Old Wall Street. But we get along, so that's fine.
We do, and I've always been a lone wolf in that regard. When I worked at Morgan Stanley, the branch manager called me and said, you know, Chris, you're trying to manage money here. We gather money here is what we really do. And he didn't say it in a bad way.
No,
he said it. He was right.
Yeah, it's the truth. The art of running money is having money to run.
And he absolutely was right on the money.
And that's where the marketing, I think, comes into a large degree. But at the end of the day, that's kind of been debunked. I think most people understand at this point that just doesn't work. And this isn't a marketing game anymore. It's for people. It's real risk. It's real money.